Hi Jay, good evening.
Hi Ramya, good evening. How are
We
you?
are all in a festive mood with the holidays starting.
Yes, yes, yes.
Okay, so in today's discussion, Jay, I thought we would talk about LEAPS options. I know it stands for long term equity anticipation securities, which is an acronym that nobody ever thinks about, and everybody just talks about LEAPS options. And my understanding is that this is typically options which are dated like a year or more out in the future. So I'm looking to see how I can use LEAPS for something like a stock like Nvidia that I'm bullish on. So maybe we can look into the details of that.
Sure. That's a great one and a great topic, especially to kickstart our holiday season videos, Ramya. Number one, I mean, like you rightly said, nobody uses this term, the actual definition of the leaps. I view it like you are taking a leap of faith on a stock, which you believe that will go up, and leap technically leap is done, I mean, beyond a year, like you rightly said. And also, folks also go deep in the money, which we will discuss
Okay.
and elaborate when we look at the options chain and all that. It is it is almost considered as something which will behave like your stocks.
Okay.
Let's say, I mean, you said Nvidia is the stock that you're looking to do a leap option on. This particular session, we will look at only the leap call option, and we will not go into the details of the leap put option. So
Okay.
for the leap call option, it can technically play like you're owning the set of stocks if you're going very deep in the money. From that point of view, let me actually open the options chain on Fidelity and then look at Nvidia. Let me just do only the call options, not the puts. And I have taken off the weekly options. And since we mentioned leap, I will possibly go 1 year from now. So does January
Right.
2027 look okay to you? Yeah.
Yeah. Yeah.
Yeah.
That's
So
fine.
let's look at January 2027. There are multiple strikes, and then in fact, people are so bullish. There are people who are betting on 340, like looking at Nvidia going to 340 and all
All
that
that
as well.
number. Yeah.
Right? If you actually, when I said deep in the money, I would typically people go anywhere between 60 to 80 delta.
Mhm.
Let's look at 80 delta Nvidia for now, which right here at 140, if you can, the delta is 80, 0.80 means 80 delta.
Right.
Reason for going this deep in the money is when you're buying an option, you're paying for the intrinsic value as well as the time value. And as you can see here, I mean, as you go up, you're paying a lot more for the extrinsic value. All of these strikes, you're technically paying only for the time value. There is no intrinsic value because they are so far out from what currently Nvidia is trading at. So when
Trading.
you look at 140, the bid ask is anywhere between 60.15 to 60.55. Let's assume that it gets filled at 60.30 or something, $6,030.
Okay.
You're technically paying almost close to, I would say, what, two-thirds of the money for its intrinsic value. And then there is something that you're paying for the extrinsic value. So as time goes by, as you all know, when you're buying a call option, nothing happens to Nvidia, the theta value will decrease. So which implies that your premium will be eroding. So when you're going deep in the money and then looking for a call option, you're looking at 80 delta so that the amount of money that you're paying predominantly goes to the intrinsic value and not to the extrinsic value. Not so much on the extrinsic side. I mean, if you look at a 60 delta or so, as you can see here, 63 delta and things like that, you're pretty much paying so much for the extrinsic value, not for the intrinsic value. So I would rather go for 80 delta, pick up this strike, and then my enter in, enter my Nvidia call option, and then simulate and see how it plays. Do you have any
Okay.
questions, Samir, on this?
No, let's move forward on this and see how we could simulate how this behaves when NVIDIA moves up.
Absolutely. Like you rightly said. And the other thing is, Nvidia is currently trading at 180.93, as you can see.
Right.
This when you buy this option, you're technically paying anywhere between $6,015 to $6,055, assuming that it gets filled at the mid price, 6,030 or something. Instead of shelling out $18,000 today, if you have to buy 100 stocks of Nvidia, you have to spend $18,000.
Right.
And you're bullish on this. So instead of buying Nvidia stocks, you are entering into this buy call option, paying almost close to 1/3 of the money that you would have spent otherwise buying the 100 stocks of Nvidia. So having said this, plugged in the details here.
Yeah.
See, as you can
And
see,
it's 1/3 of the money for something that is at 80 delta, which means it's almost like owning 80% of the 100 stocks, right? Like, yeah.
Absolutely. As of today.
Yeah.
If Nvidia goes up, that delta will increase. If Nvidia goes down, that delta will decrease. So that is something that we need to be aware of. So if you can see here, this is assuming that we are giving the ask price itself, not taking any bid price, right? So this particular simulation, when I entered, it was 80 delta. And I have actually simulated this in such a way that, since you said that you're bullish on Nvidia, and Nvidia went up to 212, I think it hit 212, and Nvidia's earning is somewhere in the third week of February.
Okay.
So here I had entered, assuming that Nvidia goes to 200 on February 20th, 2026.
Okay.
Right? You're not waiting till the expiry, right?
Okay.
What happens to this particular buy call option? As you can see here, this is the current date. 2/20/26 is your simulated date. 1/15/27 is your expiry date for this call option. Technically, this you can actually have unlimited profits on this, but that is unrealistic. It cannot go to infinity. Let's assume that it goes to 200 by February 20th. All I wanted to show you was the amount of profit. As you can see in this second line, when it hits 200 on February 2026, the delta that we chose was 80. Now the delta has gone up to 86.
Okay.
And you are making a profit of $1,266. You spent $6,055 and you're making $1,266. Let's assume that instead of, and you can just close this contract and then book this profit, or you can choose to exercise this contract, then buy Nvidia at 140. But it's not 140 because it is 140 and you have already
paid
$6,055. So typically people won't buy it when it hits 200 by February. They will wait till the expiry because you're still having so much of extrinsic value left in this contract. And that is the reason when you close it, you're making this much of profit.
Correct.
And let's assume that you bought Nvidia today, right? 100 shares of Nvidia. You would have paid 180.39 per stock. This is assuming 180.39. And then the cost basis is, so 18,000, you would have spent $18,039. And when it hits 200 on February 20th, the profit that you're making is 1,961. You're getting, a little bit higher profit than the buy call option, but you've spent $18,000 to realize this amount of profit. So that is the advantage of getting into a leap option. Number one, you can get into this with a lesser capital. And also, let's say that Nvidia doesn't go up at all. The max loss here is the one that you have paid, 6,055. The max profit is, let's say, if it hits 300 or 330 or whatever it is, $300, let's say by February, you will make $10,661 on February 20.
Yeah, a little far-fetched, but yeah, it's a theoretical possibility.
Yeah, so basically, you're playing with limited capital, but with maximum potential. Using a delta is to make sure that you not so much on the theta decay.
So the return on investment for the upside is higher for the option if Nvidia moves up. In the short term, I could make a much better return with the leveraged option.
Absolutely, Ramya.
All right, that's great, Jay.
Thank you.